So if you're working with your sales team and you're working and you're trying to figure out, what metrics are the sales team really interested in, or what metrics should the sales team be looking at? So here are a couple of things that your finance team, or that you as a finance person, or if you are the salesperson, here are a couple of metrics that you should ask your finance person to provide. First one is definitely going to be revenue, because you want to understand, what are we selling now? Also, you want to understand, what are we recognizing revenue on? Because this is where it becomes very, very important for the accounting and finance team to stay connected to the sales team, because you may be selling things in the sales department, or you may be structuring your contracts a certain way. But if you don't have a clearer understanding on how the revenue actually gets recognized, you may not realize that, hey, you're structuring your contracts in a way that you're not really getting the full credit for, or you're structuring it in a way that, hey, you know what, the revenue gets recognized over a longer period of time. So your accounting team should be working with you to help you understand, what are the accounting implications on how we recognize revenue on these deals. And this especially comes to be very important when you are a organization that sells products over a contract period, especially if you're selling the products over the contract lasts for multiple years. Your accounting team should be helping you understand, hey, how is the revenue going to behave for this product? The other thing that you really want to understand is, you definitely want to understand your commissions, and you want to understand the commissions of your team. Now, I know a lot of finance and accounting people don't spend a lot of time on this, because some organizations see this as kind of a payroll kind of function. But the finance team should be keeping an eye on this, because they should be looking at some of the simple metrics between, commissions as a percent of revenue. They need to be looking at commissions as a percent of new deals closed or new sales made, because when they're looking at that, they can start to understand, are we incentivizing the right behavior for the business? Are we incentivizing our sales team to act in a way that will actually not only provide for the business, but actually help the salespeople have a successful or effective career with your organization? Because if you're not looking at the way that you're paying your sales team, or the way that your commission payouts are working, then you could be in jeopardy of, having your commissions encouraging your salespeople to do something that is not in your best interest as a company. So you want to make sure that the finance team understands that, and that they're providing you with that information and that perspective. And then you also want to understand, what is your average revenue per customer? Because this is an area where I've spent some time with different companies, and what we begin to realize is that, in the goals of just, hey, we got to meet our sales target, and they're going out and they're selling all these products. And then what they end up finding is that they end up starting these long-term relationships with customers that really aren't buying that much from the business. And then when you really look at the cost, it's like, this customer may only be buying, a couple $1,000s a year from us. But when you look at how much it actually costs you to keep that customer up, then when you think about, the time that the sales team puts in, or the time that the customer reps, or the client success, however you define that organization, the time that they put in and the money that you spend trying to, keep up with that customer's demand, you could be actually losing money. I mean, yes, you made the sale on the front end, but all the costs does not make sense, because the customer's orders are so small. So you want to make sure you're looking at that. What is the average revenue per customer? Because if you start to understand that, you can watch the trends, and you can ask yourself to say, hey, you know what? Based on the type of business that we have, and based on how much it actually costs us to run the business, it doesn't make sense for us to go after customers that are, let's say $5,000 lower. Or if you're a more high-end business, you may say, hey, if it costs us, $50,000 to acquire and support a customer, it doesn't make sense for you to sell products at $10,000, if that's all the customer is going to order, then what you may need to do is figure out, hey, do we need to come up with a different version of our product? Do we need to come up with a version of the product that doesn't have all the bells and whistles? Now, this is something that was very, very important for the auto industry, because I mean, when you think about I think an example would be a company like Toyota, where Toyota also makes Lexus. Now, if a person's coming in, they're going to buy a car, they may not have the money to buy a Lexus, or they may not be interested in buying, or they may want some of the features of a Lexus, but they can't afford it. So one of the things you can look at and say, okay, all right, you know what, a Toyota in reality, for the most part, a Toyota is just very similar to a Lexus, but there are a lot of bells and whistles that they take out of the product. So you can get some of the same, I guess you say, functionality as a Lexus, but you get it with less features, and you get it with at a lower price point, because it doesn't require as much cost to, let's say, to make or to produce a Toyota as it does a Lexus, because it doesn't have some of those very, very cool features that are in a Lexus. And when you look at your own business, you have to look at that to say, okay, all right, if the average revenue of our customers is lower than our average cost to acquire them, then maybe we need to either raise our price, or maybe we need to look at taking a different product strategy. Maybe we need to come out with a product that has less features so that we can get that in better alignment. And then another thing that you really want to make sure that you're paying attention to is you want to pay attention to your conversion rates. Now, this becomes very, very, very important when you start looking at planning and you start looking at the future, because if you are not watching your conversion rates, then you have very little idea on how much it actually takes you to grow or to meet your targets. For example, if you're looking at your conversion rates and you're like, hey, for every customer we win, we had to talk to 10 different customers. And if you had to talk to 10 different customers, then you ask yourself, okay, how much did that cost us in marketing? Or how much did that cost us in resources so that we can have 10 customers in the pipeline and in hopes to close one deal? Now, with your finance person is looking at that, what they are then doing is they are then taking those assumptions and putting them into your long-term financial models, because when they have that data, they can start projecting out to letting you know, hey, this is what the business is going to look like based on the activity that you're doing. This is what our revenue is going to look like. This is what our cost structure is going to look like. And this is what our cash flow is going to look like, because they can take those basic assumptions and run it through their financial model. Now, they need to be communicating that back to you so that you as the sales team, or you as the sales director or the VP of sales, that you understand, hey, am I giving my team the right tools, and am I giving my team the right targets and the right resources to make sure that we as a business can win as a business, and that the sales team is contributing to the positive impact of the business